Hey guys, what's up? Alec back with the daily stock market, and look at that. Rivian is down 12%. So we're going to be going over a few different stocks that have been absolutely brutalized. We're going to go over the top stocks that are down 60% or more. Right now, we have Rivian from all-time highs down 68%. It topped out at $172 per share, and a lot of investors were buying above $100 per share on Rivian because the hype was absolutely real. If you've been following my channel for a while, you remember when Rivian IPO'd back in November. I was telling everyone to stay away from it, very far away from it, because the market cap was around $100 billion. All right, so it was even competing with stuff like Ford. It had like a bigger market cap than Ford and Toyota, and it hasn't even delivered one vehicle yet, which is always a red flag in the stock market, and you know that's when hype is taking over. Now, personally, I want to see this one release their earnings, which are going to be available on March 10th. Last time they reported earnings, they were expected around -5 EPS, and they reported around a -8 EPS. So they missed horribly. I think they're going to miss horribly again. So some puts on Rivian could be appetizing. However, I'm probably just going to play a defensive on Rivian and wait for them to report earnings. And if they drop like 10 or 20% down to like 35, maybe $40 per share, that's when I'll start my position. However, I won't be going heavy on Rivian until it's closer to $30 per share or even under that. Just to do a quick little summary on Rivian, we won't spend too much time on them, so you can kind of read this. Since the opening price of the IPO, the stock is down 46%, while the S&P 500 is down 5%, and Rivian shares can fall another 82%. Falling knife, Rivian is down 68% from 52-week high and 82% downside movement remaining. Okay, so you can read that a little bit. To justify the current price of $60 per share, Rivian must immediately archive a 6% margin, slightly below Tesla's. All right, so they basically have to be on Tesla's level. They also have to grow revenue from $0 in 2021 to $81 billion in 2030. In this scenario, Rivian would generate $81 billion in revenue in the fiscal year 2030, which is 171% of Tesla revenue, 61% of General Motors revenue, and 60% of Ford's revenue, respectively, which I don't think that they will be doing. And that's, remember, that's 8 years from now. So that's just justifying at $60 per share 8 years from now. So if they do that, then they could be at $60 per share, but you definitely don't want to wait 8 years. This implies revenue is also used to calculate the implied vehicle sales below. Optimistically assuming a starting price of $70,000 for the Rivian R1S as an average selling price. Rivian current valuation implies the company will sell 1.2 million vehicles in 2030, or 4% of the projected global EV passenger. So they would have to have a huge market share. They would have to sell 1.2 million vehicles. So overall, we won't spend too much time on that. That's what I'm kind of skipping through the article because I want to go over a lot of different other stocks in this video. Overall, Rivian is very, very risky, but there is some reward to be had because if they end up dominating market shares, they could fly to $100 per share, in my opinion, but that's probably going to take at least 5 years. And again, I want to buy them under $30 per share to get a better price. Next one up is a no-brainer. It's one of my favorite stocks on this list that's down over 60%, and they're down around 65% from all-time highs. And of course, we're talking about PayPal. They're a huge merchant processing company. They own Venmo. They're going to be tapping into the blockchain more and cryptocurrencies, and they can be a leader in the blockchain and cryptocurrency banking space. If JPM and Bank of America doesn't really fulfill that role, I think PayPal and Square will definitely be the two leaders in that space. And here you can see in 2019, they were more money than they were today. And the business, if you look at the financial numbers in the last 3 years since 2019, the company has grown tremendously. Overall, I think you're going to be getting a great deal with a $124 billion market cap and a 30 PE ratio. All right, the next one we're talking about is going to be Draftkings, and this is a stock that I actually like for long term. All right, however, we see them up 27% in the past week, so they're actually having a nice rally. They were $18 per share earlier this week. So if you guys scooped up a few shares at that price, under $20 per share is pretty much the sweet spot, in my opinion, for DraftKings. And I think that we can see a pop back to like $30 or $40 per share. This is going to be a more of a long-term hold in the next 12 to 24 months. A lot of things can happen with sports gambling. You guys have to remember, sports gambling has just started getting legalized, and it's still illegal in around 30 different states. All right, and I think that eventually it'll become legalized nationwide. And once that happens, it's going to be very good for DraftKings. Remember, they were in the fantasy football kind of space, building their audience and building their consumer base, which was a very smart idea. It's what a lot of beginning companies do. And then they monetized later on after they built their company and their audience. Okay, so DraftKings, for example, this is one you want to get in early, under $20 per share, because if you hold them for a long time, they are already one of the leading brokerages, bookies in sports betting, and I think they will continue to hold that spot for the next 2 to 3 or 5 years. I think the future is pretty bright for DraftKings. Obviously, there is a lot more risk with this one, so keep in mind with that. But with the risk versus reward, under $20 per share is more attractive, and they're down around 70% from all-time highs. All right, now another interesting one's going to be Twitter at $34 per share. All right, they're down 22% in the last 3 months, 54% in the last year, and if we pull up an all-time high, you can see they peaked at around $77 per share, and now they're 34. So this stock has been absolutely destroyed. Now, under $35 per share, I think is a great place to start a position. You can see in 2018, they were $35 per share, so they were more money 4 years ago. They're pretty much going on a 4-year low right now, which I think is a huge buying opportunity for something like Twitter, because if you guys use Twitter, then you know, especially for cryptocurrency and stock market and stuff, Twitter is becoming a hub for social media, cryptocurrency, and stocks, and just like information in general. The president, for example, is always tweeting out tweets. Celebrities get the news out through Twitter. So it's one of the dominant social medias, in my opinion. And I think they're also creating a space that other social media companies just can't compete with. They're also verifying NFT profile pictures with the hexagon image. They're a negative earning company. They're only a $27 billion market cap. So if you compare that to something like Instagram or Facebook, for example, you can see that Twitter is a very small company, social media platform compared to some of its peers at a great price. However, they are not profitable right now, but they're working on their profitability tremendous from Q3 21 to Q4 21. They made a huge improvement into positive EPS. And what's going to happen moving forward, if you guys are familiar with Twitter, they just implemented Twitter Blue. So now they're going to be charging people like $2 or $3 or $4 per month. Forget the exact price, but that's going to help tremendously with their profitability also, and it'll include a little bit more extra features. So I like Twitter overall. I'm buying under $35 per share, but I plan personally on holding for 12 to 24 months, no matter what happens. If they go below $30 per share, trust me, I'll just be loading up more for long term. I think Twitter is a great play that you can't go wrong with right now. And remember, these are just all my own personal opinions. They're not financial advice or anything like that. We see Roku is the next one on the list, and they're down like 7% today, but now a lot of the stocks are recovering later in the day. They're also heating back up, 18% up on the week. They were down to $112 per share earlier this week, but they've been absolutely decimated as well, down 68% in the past year. And from their all-time high, they're down like 70-something percent. Okay, this is a company that I think is going to be around for the long term. When you buy a TV nowadays, the Roku pretty much comes built in. Their only real competitor is the Amazon Fire Stick. Okay, but Roku, I think, is going to be around for a while. And you can see right here, Roku did have a lot of hype behind it. It rose 375% in just the span of like 6 months or so. So it went on an absolute tear. But if you take that out, it's pretty much at it's following its pattern right now. So it could be a good place to buy under $150 per share. Personally, I want to buy closer to 125 or under $125 per share, but I wouldn't mind starting my position under 135. So as you can see, it looks like it's following the plan pretty well. So as you can see, it looks like it's following that support pretty well. It'll be interesting to see how the resistance shapes out, though. I think they could easily go over $200 per share in the next 3 to 6 months, but a safer bet might be in the next 6 to 12 months for $200 per share on Roku. The next one up is a fan favorite, NIO. We had them down around 5% today on the day. It's Wednesday by the day. By the way, the day I put this out is the day I'm recording it. We see them recovering intraday movement of around 5% upward movement, and we see a 46% downward movement in the last 3 months. From its all-time high, we can see a 60% drop on NIO stock. I think NIO is getting attractive. Under $20 per share is a sweet spot for NIO. And this is one that had an absolutely tear, up 860 something percent in just the span of around 6 months. It was unstoppable. It went from $2 per share all the way to like $60 per share. If you guys have been around the stock market that long, you definitely remember it. That's probably why it's a fan favorite, is because people have been in the stock for a long time. Now, as you can see, it looks like that it's been making this downward movement gracefully. So just be aware, this could be a falling knife. It could continue down to like $15 per share or lower. There's really no bottom right now. The only other support we really see is right around $18, $20 per share. And then below that, we see like $15 per share. All right, so $15 to $20 per share, I think, is a great place to buy NIO for long term. This is another long-term stock. It obviously does have fast short-term movements that it's had in the past, but I don't know if we're going to see anything like that from NIO again, because the hype has totally worn off of NIO, and it also has the China stuff. It's a China-based company that it's combating, and obviously the China stocks are not a good taste in the investor's mouth right now, so people are typically staying away from China stocks. I like investing in at least some China stocks. It's a good diversification to your portfolio. It's a good hedge against New York Exchange stocks, even though NIO is technically a New York Exchange stock. But you know, it's a hedge against American companies, and investing in the success of a China EV electric vehicle market, I think, is a great thing to diversify yourself overseas in, and NIO is one of the leaders. They're getting to a very attractive price point. Obviously, some people were buying at 50, 40, 60. So if you're buying there, you might as well lower your average cost just a little bit. But remember, my price points are set between $15 and $20 per share. For long term, I think the long term is where NIO's really going to shine, because they're going to start putting up killer numbers once they dominate China EV market and move over to Europe. Even though I don't think they'll do too good in Europe, but China alone, I think they can absolute dominate there. Now, the last one we'll talk about is one of my favorite ETFs, but you have to know what you're getting yourself into with this ETF. It's very high risk, high reward. Okay, so if you want to be hands off and you want some high risk more than a normal ETF, this is going to be the ETF for you, ARKK. And Kathy Wood constantly manages this fund. She sells hundreds of thousands of shares all at once. She buys hundreds and thousands of shares. So she makes sure that these holdings are always optimized in the best way possible. And as you can see from the all-time high, which they peaked at around $150 per share, you can see that they're down around 60% from their all-time high down to $67 per share. I think this is a great one to be loading up for in the long term. And before ARK even had that massive movement and anyone even knew who Kathy Wood was back in 2018, back in 2020, you can see that the share price is basically almost the same price it is today. So all the hype wore off. Obviously, this was the best performing ETF in 2020, up around 200%. And for an ETF, that's absolutely ridiculous for a stock, for an ETF to be up that much. So with that being said, I believe in Cathie Wood over the next 2 to 5 years. I have a lot of ARK ETF. I have over $5,000 in ARK, and I even own some of her other ETFs like ARKG and ARKW and a few other of her ETFs as well. But ARKK is the main one I'm loaded up on for long term of her ETFs. So here you can see what's in the fund. The sectors, you'll see healthcare is 35%, technology is 34%, and then communication 17%, and so on. The top 10 holdings are going to be Tesla #1, Roku, Teladoc, Zoom, Extract Sciences, Coinbase, Unity Software, Block, and Twilio, and then Intelia. Okay, so it is high risk, as you can see, like Roku, Teladoc, Zoom. A lot of those ones have been beaten down very significantly. That's why you can see the stock is down so significantly. But she's always making changes, and obviously she thinks like Roku, Teladoc, Zoom, Unity, Block, Coinbase can all bounce back. We've also seen Tesla bouncing back in the last week, around 20% upward movement in the past week for Tesla. So I just wanted to make that quick video for you guys. Come on here, let you guys know my thoughts on the stocks that are down 60% or more. I'm definitely going to be making a part 2 of this video, so make sure you're subscribed with post notifications on for that video. I didn't want to drag this video on too long, so that's why we made it a little bit shorter. Let me know if you guys like the shorter videos or the longer videos. Message me here on Instagram if you want to join my close friends list. If you want to see some success that people have had, you won't be able to see these green highlights here. That's for the close friends list only. But you can click success number 4, you can click success number 3, and read through some of these highlights on people making money in the close friends list and what's included. If you're interested, just shoot me a message here on Instagram, and I'll shoot you over my website, so that way you can read through my website and see if the program makes sense to you and it's inside your budget. All right, guys, I'll see you in the next video. Share this video with a friend. Don't forget to like the video, comment below, and remember, don't time the market, buy the market. Peace.